So before we kick off segment 2, we just wanted to remind you, please like, share, subscribe. Your support is appreciated. So we always kick it off by looking at what is happening throughout, the key products that really drive mobility, big backdrops for the economy. And this current week, we came in at 15.326 million barrels per day versus last week's 14.925. That was that bounce that we were expecting, and now we expect to see a bit of this cooling off a little bit and then staying a little bit weaker. And again, that we're not saying anything that doesn't happen seasonally, just this is something that then we'll get that spike ahead of, a week or two, depending on timing, ahead of Thanksgiving and then the week after. So that's something that will also show up in the data, which you can see with some of these spikes. And I think it's the most prevalent in 2017, where 2018, you started to see this get pulled forward ahead of time. There is a chance we could see that as well, because there's such an issue with the supply chain. Ensure that there's gasoline available at the at the retailer. But again, these are going to be things that we're going to be watching as we prepare for what's happening this Thanksgiving. In general, the 4-week rolling average is coming closer down. It's below that average from 17 to 19, obviously above where we were in 2020. But here's where, again, what we've been saying is that we're going to be seasonally normal, just a little bit below where we normally are at this period of time. And that's something that we think is going to continue through the end of the year. Now, when you look at distillate, so distillate had an increase of 2.16 million barrels. It's only 7.4 million off of the 5-year average. But when you look at that 29-year backdrop, you can just see where those swings are and where we are versus that 29-year average in general. It's just important to keep this in mind when you're looking at what are some of the opportunities, where are some of the shortfalls. Then when you look at where those shortfalls are, pad 1 is the furthest down below the 5-year average. So it's 10.1 million below the 5-year average, but there was a build of 2.02 million. That's something that we expect to continue because, again, where do you use the most heating oil? There's a lot of it that is going to be in the New England area. So we really want to see that pad 1A, if you will, see the most amount of increases, because that's where the shortfall is, and why when we talk about all of that product showing up in the Atlantic Basin, it has that option of going either into Europe or into the U.S. Pad 3 had a small draw of 140,000 barrels a day, very in line with 5-year. With Pad 2, a draw of 670,000 barrels, but it's still 1.7 million above the 5-year average. So then when you look at imports, so imports dropped a bit from 325,000 to 1.9 to 190,000. The drop was driven by Pad 1, which had a drop of 129,000 barrels a day. This will reverse based on what we've been talking about. We said it in segment 1, where we saw that there was a decent amount of flow coming from Europe into the U.S., and that is something that will show up and continue to show up. And the same can be said when you look at Pad 5 and what is coming from Asia at this point in time. Here's where we got it wrong. We were expecting to see this demand spike up and come back to the 5-year average. Instead, it spiked down once again. It's just a matter of timing. That's something that we still expect to see this increase. It's just going to be that bigger makeup when we look at what is happening in general. And we'll talk about why in a minute, because we are seeing that pivot, and there is that increasing demand for fuels, especially when you look at road fuel. So you had that decline, but as we were saying last week, we expected to see a strong snapback, and we're right back to where we were. We expect this to continue to push higher above 150 as the final push happens ahead of the holiday season. You can see rates are still struggling here. They should be moving up given where diesel prices are continuing to drive higher, but instead they've kind of flatlined. It also depends on what type of rate we're talking about. And a lot of these rates are contracted. So, or I should say some of them are contracted, which also mitigates some of those increases. And they're trying to do things to mitigate some of the labor side, which again is why we continue to see labor shortages. So load availability starting to tick back up. That is going to continue to drift higher again as we look to move things into position as inventories remain dangerously low heading into the holiday season. When you look at rail traffic, we had a increase of total car loads versus last week of last year of 4.9%. continues to be coal. That's going to be the bigger driver. And then when you look at farm products, that's going to remain strong. And then you look at forest products, grain, again, is going to continue to be strong. Last year was gangbusters. So it's a tough comp, but again, still very strong for where we are this time of year. Metallic ore is still staying strong. Motor vehicles and parts, as we've been saying, all of those issues that we continue to see still remain in place. That's still going to be an overall problem. And the petroleum and petroleum products is the one that we think is going to see the biggest increase, especially as we head into the winter season of getting some of that product from Pad 3 into Pad 1. But then when you look at intermodal, again, continuing to rally back from some of the, especially from last week, but still 7.3% off of average. Off of last year. And that's where, when we look at total traffic down 2%, a lot of that is really being driven by the motor vehicle and then the intermodal side. Now, we do expect that intermodal to close some of that gap, but still be below where we were from back in 2019 due to the issues on congestion, labor that we've been talking about in general. So then when you look at ships, they keep showing up, especially when you look out through November. So there's, again, they've talked about going 24/7, but if you talk to anybody that's worked there, they've always been 24/7. The issue is getting all the cranes to operate at the same time. Which union is operating which one? How do you kind of get them to play nice to make sure that we're operating all the cranes available and trying to speed through this trucking side? Because and we tweeted out the article that was written by a truck driver, essentially saying that the biggest issue is going from the crane to the truck and getting the truck through the system. So these are things that we really need to address, and asking the people on the ground the best way to do it, I think, is the most pivotal, as these import volumes are going to continue to go up because we have a lot of boats still sitting offshore. When we look at the temperature side, temperature has gotten a little bit warmer, especially for some of the key areas that would require some of that heating side. So obviously, when you look at west of the Mississippi, you can see things have gotten a bit above normal. It'll still require heating. It's just not going to require as much. So again, it's just going to be a matter of how much fuel oil we're moving through, or heating oil in general, how much natural gas is being burned. And then when you look at the Northeast, that's where, again, we're still sitting in mid 50s, but it's a matter of what is normal. Where are they right now, and what do those heating degree days look like? And they're coming down a touch still, seasonally within a range, but just on the lower end of the range, which is a net positive if you're looking at trying to make sure we have enough natural gas, make sure we have enough propane and heating oil for this coming winter. Now, when we switch to gasoline, gasoline had a drop of 1.49 million. That's 7 million below the 5-year average. But when you look at that 29-year chart, you can see we're very much in a normal backdrop. This is where we have this drop, and then we start to pivot. It's either this week or next, and then we get a steady increase in builds. And it's really just driven based on what is coming in on the production side. So as we said before, the production of gasoline dropped 109,000 barrels a day, or 61 basis points. But when you look at distillate had a big increase of 251,000 barrels a day, or an increase of 1.72%. So when you look at gasoline is still elevated. But when you look at just diesel, distillate remains the focal point, because that's where we're the shortest. That's where the most margin is right now. So gasoline is going to start to get thrown off, but this is just something that is being managed. Pad 1 had that bounce that we talked about on imports. Imports increased 174,000 barrels a day, 163,000 barrels a day into Pad 1, 43,000 barrels a day into Pad 5. It's going to stay around this range. There's not much to say one way or the other. There was a decent build, sizable build really in Europe. So as Europe continues to rise, that could open up a little bit of an arb, because when you look at the shortfall in gasoline, the shortfall is really driven mostly by Pad 1. Pad 1 is down 7.4 million barrels versus the 5-year average. And again, that's where we could see some of that arb open back up again. And then again, these are going to be some of those those important points when you're looking at where's gasoline, where's diesel, what does it make sense for refiners to make given their costs remain elevated with natural gas right now at $5.72. And again, that's driving up their feedstock inputs, and really where are some of those prices overall. Then when we look at gasoline demand came down a touch. Again, kind of finding this comfortable zone here. According to Gas Buddy data, weekly U.S. gasoline fell for the second straight week by 0.3%, but was at the 4-week average. And one of the things we've been talking about is we expect it to be fairly close to that 4-week average. We'll get, again, that normal spike that we normally have as we go into Thanksgiving, but we just expect it to be fairly seasonally normal, just a touch below that norm. And the reason why is weekday demand. And weekday demand is just because we still don't have the full amount of people going back to work. You have that advent of more flexible schedules. So that just takes some people off on the weekdays. And then you'll see some of that additional come in on the weekends, but not enough to make up that difference, keeping us just below that seasonal norm. This is just giving an indication of what we're talking about in terms of the back to work barometer, where you're still well off of normal for New York, Chicago, Austin, Washington, D.C., San Fran. Just kind of giving you an idea. Obviously, Texas has come back much faster, and it's about 50% below normal, where a lot of these other places are about 70% below normal. And we just see that maintaining through Jan 1, just based on what companies have said, where things are sitting right now. And there's some people starting to trickle back, especially in New York. I have friends, anecdotally speaking, I have friends that are going back 1-2 days a week, and that's something that I think will continue to trickle through, especially as we get. So then the shock in January won't be as big, but there will be that step up that we're expecting that will be Q1 of 2022. Now, when you look at what are some of the travel plans, I think it's important to look at some of the travel activity here. So when we look at the plans, this is looking at Google searches. So right now, there's really no slowdown evident in consumer Google searches for going out, and that's looking at car rentals, flights, hotels, has been picking up. And again, I think there's a lot of pickup in terms of what are we going to do for Thanksgiving? What are we going to do for Christmas? And when you think about the difference between the two, when you look at last year, we were heading into an increasing situation and an additional fear. Not as many people were vaccinated. So you had a slowdown that was happening in October through November, and then you had that big increase as you had people getting vaccinated. This is where when we look at the seasonal norm, we normally see people searching a bit more. It's something that I think people are also trying to find deals. There's obviously not as many deals because things have normalized enough to take away some of that low-hanging fruit. And what do? You search more to try to find the best deal possible. So that's when you look at what are Google search trends saying. But then when we dig down to some of the surveys, the highest income travelers are most likely to cut back on Thanksgiving travel. And again, you're seeing this for what it is. It's, you have to think this is among 2,200 people who were surveyed. So just, again, keep that in the back of your mind. Gallup polls are showing something similar. So there's really some continuity between this. And when you look at all adults, so will or might travel in 2021, or 35%, always or sometimes traveled before COVID-19, 47%. So you're seeing some of that drop, and that drop is really being driven by the two higher entities. And it could be that you've already done it, you've already seen family, Thanksgiving is going to be low key this year, or you're really kind of storing up for making Christmas something much bigger after kind of avoiding it last year. So there could be just some of that pivot where maybe Thanksgiving is a bit lighter and then Christmas is much stronger than normal, and we're going to see some of that kick back. But again, these are things that we're always going to be looking at to try to find the best available data. High earners just gives you an idea to cut back on mid-length road trips. So one of the things that we're also seeing is that even if you are traveling, it's more of a day trip. So it could be that, look, it's a 2-hour, 3-hour drive. We're going to be drinking, having fun. Let's stay somewhere. Oh, how much are hotels now? All right, let's drive home. And I think you're starting to see some of that rationalization which is where you're seeing some of that pullback on 4 to 6 days. 1 to 2 weeks has increased slightly, but the pullback is on that 2 to 3 day, 4 to 6 day. So people are really doing more of that day trip and less of that kind of intermediate. And this is obviously not helping. So gasoline prices are at $3.39. They're starting to slow. So we're reaching a peak of gasoline prices, which again is a net positive. So we do expect it to see $3.40. We do expect to see that, but again, that would kind of be that real slowdown. The bigger issue is really on the diesel side. So diesel had another increase of over a penny, going to $3 and almost 73 cents, because that is what is going to really be when you look at heating oil and you look at diesel. And, there's a lot of competition coming from this side of the barrel, and this is again going to be the biggest hit when you're looking at logistics, supply chain, cost to companies, and then how much of that cost can get put into the price to consumers. And we'll talk about in the econ show just how massive the increase was in prices paid and prices received, just kind of showing how that inflation is going nowhere anytime soon. Now, when we shift to blending components, so blending components had a drop of 1.66 million barrels. We're now 200,000 barrels below the 5-year average. So getting right around that kind of comfort zone, which is something that we've been talking about, of trying to mitigate or take some of that lighter end and really hone in on the disty cut, given where that margin is right now. And that's something that we continue to see or expect it to continue at least over the next 2 weeks. Then when we look at product supplied, so here's where you kind of get the shift and everything. So typically you get a spike, right now. Instead we had that drop down, and now the spike coming up when you typically have the drop. Still at the higher end, which is a net positive, but again, it's all a matter of where does this average out, because you see a lot of that lumpiness that we've been talking about. And then when we look at where things are in comparison to the last 5 years, here's where you can see things shaking out. We're right at the line that we were at for 2017, for 2020. I'm sorry, not 2020. For the what number is that? The 20, not for 2016, but for 2017, and that 2019 level, right in that kind of comfort zone. We'll see that drop back down. It'll probably follow closer to what we saw for 2017, but we just expect the low end of that to come below where we were for that 2018, and kind of that average number kind of falling into that average level that we've seen here. But again, just still fairly within just above that 9 million mark. So then, why are we saying that? So you saw a drop in parks. For some it was a sloppy weekend with a lot of rain, and then obviously we had Halloween. So Halloween should pick things up a bit. And when you look at where the transit station dipped down a bit, again, just seeing some of this very stable levels. Parks is going to be that biggest delta if you're looking at the weekend, because is it nice out? Can I get out of the house? Can I bring the kids somewhere? And then we'll see that kind of ebb and flow as we go through the remainder of the year. I personally like the cold. My kids, my wife needs the kids to get out of the house, so I'll still take them to the park as long as it's not, to a point that you'll hurt your face. But this is where you can see some of those movements in general. Apple trends leveling off. You could see Italy had a little bit of a rebound, Germany as well, while the UK and the US pared back just a bit. But again, just finding some stability based on what we've been talking about. And then when you look at propane and propylene builds, another build of 430,000 barrels. We're still 12.7 million below the 5-year average, but you can see that we're now above where we were in that 2017 level. So it's just going to be something to watch of where are we in versus 2017 and 2018. One of the things that we've been talking about, we expect to see a supply response, and again, not a huge supply response, but that has been a bigger focus for completions, and that'll help mitigate some of this. And then when you look at days to cover, back within that kind of base level that we saw for 2017, 2018, but it's just going to be that very important number of where do we sit, and then where do we start seeing that drop as imports still remain strong. Share of people getting vaccinated, again, things are slowing down, but still moving in the positive direction. India, again, continues to see a positive momentum as the U.S. continues to move closer to that 70%, 75% that we've been talking about. Now, when we look at jet fuel dropped 1.75 million. That's 700,000 below the 5-year average. One of the things that we were expecting was we were expecting a bigger spike earlier. Instead, it came a bit later. Now we just expected to come just below that 1.5 million and stay within that comfort zone, just based on what we're seeing here. So the average number of departures per day decreased by just under 4% week on week, and it's really driven because for those that have been paying attention, you had a sweeping amount of cancellations due to labor issues and weather. And then obviously Asia Pacific had the biggest drop, all driven by China, as we said in segment 1. China is where we saw some of the biggest amount of reductions just based on the outbreak. So globally, the passenger flight schedule for the 11 weeks ahead has declined by 4.16% since last week, and this was the largest cut to flight schedules in several months. And a lot of that is just driven because I think China is very concerned right now, and they're going to keep some of this reduced over the longer period. And it also helps, as we've said about kerosene. If you're not burning kerosene, where can you put it? Oh, you can put it in the disti cut. You can put it in diesel. So this is also a backhanded way to also move some of this to, I think, where they need it most. And then when you look in the U.S., staffing challenges at American Airlines led to the carrier canceling over 2,300 flights between Saturday and Monday. And then the easing of international travel restrictions on November 8th will have a limited impact with a small uptick, as we've been talking about. And then China canceled almost 24,000 flights over the coming 11 weeks, which is, again, that biggest amount of issues in general, which would more than offset any increase that we'll see from the U.S. This is where we can see for the TSA right now. We're still, again, right where we've been saying we would be. The biggest pivot that I think a lot of people are hanging their hats on is what will November 8th look like. I personally have friends that have traveled abroad. During this time period, it's just going to become a bit easier. So again, these are things that we're going to be tracking to see how much is this international travel going to close this gap and put us back to where we were in 2019. And then when we look at the regional breakdown, you can see that things on the weekends, something similar, up 5%. And then when you look in the weekdays, down 10 to 15%. So now that we've gone through that, we want to go deeper into what is happening for OPEC, what do we expect, and then as we go forward, where are flows moving, because we're starting to see some of these crudes move around a bit more, and where are they going to end up over the next few weeks.